Hello everyone, welcome to Risk Management for Beginners 101. Let's start with some questions that might have brought you here. Have you ever had a trade or portfolio screaming in profit only to lose it all and then some? Bought into headline hype only to watch the market crash, or sold in fear at the bottom just to see prices soar without you? Ever been confused how much capital to risk, when to lock in profits, or when to cut your losses? Every aspiring trader and investor goes through this at first, and risk management is how you avoid these pitfalls and protect your capital. It's not exciting, super boring, but it's critical for building and keeping wealth long term. Your emotions are your biggest enemy in the markets, and a solid risk management plan keeps them in check. In this series, I'll teach you how to build that plan and approach financial markets with a strategy, not just throwing money at them willy-nilly. We'll cover stop losses, take profits, risk-reward ratios, diary management, the magic of compounding, and the psychological edge provided by risk management. I invite you to explore other strategies out there, but today I'm sharing the basics. Let's get started. Risk management means limiting losses and locking in profits to stay in the game. Every trader loses, even legends lose 30 to 40% of their trades. The difference: they control losses with a plan so they don't wipe out their accounts. Think of risk management as a lifeboat. You hope you never need it, but it saves you when you do. The first rule: never trade or invest more than you can afford to lose. And let's secure that capital with a stop loss. A stop loss is an automatic order that closes your position at a set price, capping your losses. It's your safety net, handled by your exchange, so you're not glued to charts, stressing as prices tank. Without it, losses can spiral and stress builds, wrecking your account and pushing you into mistakes like revenge trading or flipping into a long-term investor just to dodge the pain of closing a position. And here's the deal: traders and investors are in the business of being wrong. You can be wrong half the time and still make huge profit if you stick to your plan and cut losses early. Taking a loss stings, but it's vital for long-term growth. Most traders learn this the hard way, and I hope this lesson resonates before it happens to some of you. A stop loss is placed where you consider your position to be invalidated, where you'd say, "This isn't working anymore, I'm out, and I'll find a better entry or look elsewhere." Some options include swings, support and resistance levels, or using tools like the average true range, which I'll demonstrate. I cover swing stop losses in more detail in the high volume node series, but we'll cover them in great detail in the trading strategy videos coming soon. Now, this isn't an in-depth lesson on stop losses and where to use them, but more about the importance of stop losses, and I'm just going to demonstrate why they're so important here on this Amazon chart. Let's say you are an aspiring trader and you want to enter. You see the market moving up here after a pullback and you think it's a good place to enter, and you decide to put your stop loss right there underneath that swing low. And we see the price goes up, you're in a winning trade, and then suddenly price comes back, takes you out of the trade for a small insignificant loss. And what would happen if you didn't have that stop loss set there? Well, this loss, when I can grab the box, begins to spiral, going down and down and down with each day, causing stress, causing you to watch the charts more, causing you to revenge trade. I need to make my money back, I'll enter again here, and the market continues to go against you, putting that new position in a loss, causing more stress, and it keeps going, spiraling your portfolio down, spiraling your mental health with it. And that's why you put the stop losses there. Not only does it prevent all of this from happening, it limits your losses to a specified amount and allows you to position size much larger for the potential bull run, which we'll look at in the next episode. One quick method I want to just show you is the average true range bands that people use for stop losses, and you can use this in trading view. You type in ATR in the indicators and select the ATR bands. This measures the volatility of your current trend the high and the potential highs and the lows of the volatility. And you don't want price to come out of these bands because that would signal a trend change, and you want to be out of the trade when that happens, or the position. So many traders will use these average true range to set their stop loss and move it up as each new candle prints to protect their winnings. That's just one simple method. I'm not going too deep into it today. I just want to cover what stop losses are and why we use them. It takes the emotion out of trading. Instead of riding losing positions into the abyss hoping it'll turn around, you have a solid plan. It protects your capital, keeps you calm, frees you to focus on the next opportunity. For example, if you risk $100 on a trade, then you'll know your max loss is $100 no matter how far the market falls. That clarity is power. Next, we'll dive into how to use the stop losses for position sizing, risk-reward ratios, and I'll demonstrate the magic of compounding to grow your wealth. Thanks for watching and safe trading.